Welcome to the Monocle Banking Podcast, where we decode the trends, the tensions, and transformative ideas shaping global finance. As always, I'm your host, Michael Avery, and this week we're zooming into a corner of the deal-making world that's quietly becoming a pillar of modern mergers and acquisitions, transactional risk insurance, and why it's not just a deal sweetener anymore. But I think in a world with Trump and tariffs and concerns around government guarantees and trade wars, it's a strategic imperative. As global M&A volumes started to stage a recovery last year, Marsh's latest transactional risk insurance review shows a sharp rise in corporates, not just private equity, turning to this cover to de-risk acquisitions, close faster, and extract more value. Especially interesting is the uptake across emerging markets where risk is often overstated and insurance potentially underused. And that brings us to a larger issue. Standard Bank CEO Sim Chabalala recently made headlines for his blunt critique of international credit ratings agencies, saying they misprice African risk, making the continent pay unnecessarily high costs for capital. His message? Africa isn't risk-free, but it's certainly not 5 notches below Denmark. So today we're asking, can insurance, specifically transactional risk insurance, help bridge that perception gap? And what's next for deal makers trying to navigate geopolitical volatility, regulatory complexity, and all of the pricing pressure that we see in the market? Well, joining us is Nirav Modi, Marsh's private equity and M&A services leader for the Middle East and Africa. He's been at the coalface of more than 200 deals, from renewables to real estate, and brings a unique perspective on how risk is being understood, how it's being priced, and crucially, how it's being insured. So if you want to geek out on M&A, you've come to the right place. Nirav, great to have you on the Monocle Banking Podcast. Let's just start with the big picture. Your report shows an 8% recovery in global M&A volumes last year. Was the rebound more cyclical, or did you see any structural change in the way that deals were done, particularly in emerging markets?
There was obviously offshoots and green shoots that were sort of being seen on the horizon over the last 2 to 3 years. I think post the COVID world, where valuations were struggling, I think people emerged out of it in a way that they accepted the new reality and sort of became more realistic around how the world is. And I think that's where we saw the green shoots actually bearing light, right? So the last 18, 24 months have really seen a uptick around M&A activity, and that sort of reflects in terms of the percentages of deal volumes and values that we have seen, especially in 2024, as part of our report that we've highlighted as well.
And the data also shows that Marsh had its second best year ever in placing transactional risk insurance, TR insurance. What do you think has driven this growth? Is it about increasing risk complexity in a world where we're still seeing some disparity between what the buyer expects to pay and what the seller expects to receive in a transaction post-COVID? There's that valuation gap. Or is it insurance just becoming a more standard part of the M&A toolkit?
And I think what has contributed to this jump, and you're right that, as Marsh, we saw the second best year on record globally for our transactional risk solutions business. It's a combination of various factors. Yes, the fact that the buyer-seller expectation mismatch could be resolved always through the use of transactional solutions. But I think there has been a general awareness, especially in the emerging markets, around the use of these solutions and how it sort of helps both the buyers and the sellers. I think the advisory community has also come up to the table in terms of how well they're diligencing transactions. Alongside that, I think the insurance market has come up to speed. When I say come up to speed, it means that there has been additional underwriting capacity available. There have been new market entrants contributing to this capacity. What also that means is that the premium rates have come down. They've become more competitive, more digestible, hence for clients who are potentially looking to use these transactional solutions on their deals.
Interestingly, for the first time, corporate buyers overtook private equity in the use of TR insurance. What's behind that shift? Is it just a case of corporates catching up with what PE terms have long understood?
I would definitely say a yes, but also what that means is that the corporate buyers, especially as part of their diversification plans, consolidation plans, they are looking at getting strategic sponsors being sort of the counterparties, or financial sponsors being the counterparties. And that's where they've sort of, seen negotiating table turned around them. And as part of that, transactional solutions has made a better dent, and better usage has come up as a result of that. So interestingly, as you rightly mentioned, historically, while private equity buyers used to be, pretty much the users of transactional solutions, that shift has been pretty dynamic in the last year or so. We've seen more corporate and strategic buyers now sort of coming up to the fore as well.
Maybe before we talk about some of the innovation, you could also just take us through transactional risk insurance as a vanilla, how that works before we talk about some of the innovation, because we are seeing things like synthetic warranties and more tailored solutions increasingly being adopted. What is a vanilla TR solution? What does it look like? What does it seek to cover and protect and insure against in a typical M&A context?
I'll try and make this as simple as possible, Michael, again, for the benefit of the listeners. It's very simply put, it protects the breaches of the representations and warranties that are being made by the seller under a transaction document, typically known as the sale purchase agreement. And it backstops the liability that the buyer would sort of entail if there was a breach of any of the reps and warranties under the schedule represented under the SPA, or the sale purchase agreement. So rather than the buyer depending on a indemnity or a liability being provided by the sellers, the buyer has a direct recourse onto the insurance policy. Again, most of these policies are underwritten by London-based insurance companies. Again, all of these being A-rated securities, or large number of them being A-rated securities. So it gives a layer of additional comfort as well to purchasers of this insurance, that they have somebody to go after rather than going behind the sellers, undergoing a litigation process, etc. So it's a simplified way of managing deal risks, and to the benefit of the buyers in most cases.
Yeah, absolutely. And when we look at the ability to execute on a transaction, it seems more common now than it ever has been for that kind of insurance to be in place to get a deal over the line, to give that confidence. It also is a very specialist area to underwrite. Marsh is one of the biggest insurers in the world. What kind of skill is required to correctly price and underwrite that risk in a market like the Middle East and Africa, where we know there are sophisticated pockets across the continent, in East Africa and over on the west side, in Lagos here in Southern Africa, and Morocco as well, very strong private equity. But what are the skill sets required to price and effectively sell and grow this product across the MEA region?
Again, very interesting question, Michael. And probably what I said earlier as well, it's a combination again of various factors. Now, from an underwriter's perspective, when you look at W&I underwriters, pretty much a lot of them tend to be from a corporate M&A law background. So they understand how reps and warranties are negotiated under the transaction document, and which is where they have a very sort of strong understanding of where things could go wrong, right? Because they historically probably have been on the other side of the table drafting these reps and warranties for their clients. So the pretty much the critical skill set for these underwriters tend to be, that they come from a background where they've either negotiated the reps and warranties on behalf of their clients, or the ones who've drafted these reps and warranties. But how certain underwriters would price this risk in a sort of a transaction parlance, it's a combination of a few factors. It depends on jurisdiction, it depends on the sector, it depends on the governing law of the underlying transaction document. And I think a very critical aspect of underwriting a risk like this is the due diligence, right? As I alluded to, the fact that pretty much a large number, or the largest number of policies, are cured on the buy side, the underwriters expect that there is a strong and robust due diligence being performed by the buyers through its advisors. Probably in more emerging markets like Africa, Middle East, etc., underwriters expect that these due diligences are performed by external agencies, and you're talking the likes of the Magic Circle law firms or the Big Fours, etc., doing, let's just say, legal, finance, tax sort of due diligences, which is where you would see most of the warranties being drafted under the transaction document as well.
Mm.
So I think there are various factors, various skill sets that define how a W&I insurance or a transactional risk insurance gets priced at.
Now, coming back to the synthetic warranties and those more tailored solutions, we're seeing a rise of those come through in your report. Could you just walk us through how these instruments are being structured in practice and what kind of risks they're best suited to mitigate?
Synthetic W&I insurance or synthetic risk, the way it's kind of done, again, its prevalence is only sort of picking up now in more emerging markets, and I'll be upfront to say that. But I think how it works is you typically, in scenarios where you use synthetic W&Is, you don't necessarily have a transaction document which has the schedule of reps and warranties being provided by the sellers. Now, this could be when you're looking at transactions that is being overseen by an administrator. So a transaction where, the underlying asset or the underlying companies is distressed, or you're looking at public market transactions where you don't necessarily have, the management or a certain specific seller providing the reps and warranties. So typically what happens in the event of a synthetic W&I is, on the back of a robust due diligence, the insurance company is able to draft the reps and warranties into the policy itself as if they were contained in the transaction document, right? So there does not exist any reps and warranties under the transaction document, but the same reps and warranties which otherwise would have been contained in the document is now appearing in the policy, and the corresponding due diligence done by the buyers allows the insurance companies to do that. So there is effectively a back-to-back due diligence exercise, which allows and provides the comfort to the underwriters to have the reps and warranties into the policy itself.
Very interesting. We're seeing much broader, more tailored coverage, particularly in complex carve outs and distress deals and some sector specific transactions as well. How are insurers adapting underwriting frameworks to accommodate that complexity without materially increasing things like moral hazard or adverse selection?
So the price point does change a little bit, Michael. In the event of synthetic W&Is, there is a certain, let's just say about 10-15%, or probably 10 to 20% on the range. Again, I have to give the context in line of more emerging markets, probably more African sort of transactions. So there will be an uptick in terms of a slight price point. But I think till the time, as I said, the due diligence is robust, and it's the buyer's prerogative in such instances because the transactions tend to be complex, tend to be sort of carve-outs or distressed. So
Mm,
there isn't going to be much that is going to be made available to the buyers
mm,
in terms of
mm.
from the sellers, because you don't have a specific seller, right? Or you will not have the management being
Yeah.
wholly on board. So that's how insurance companies would look at this.
What are you seeing from the data in terms of claims frequency and severity at this particular stage in the cycle?
Michael, anybody who looks at an insurance solution or any sort of a solution, it needs to pay out. Now, as more transactions use solutions like W&Is, there's obviously going to be a corresponding impact in terms of how claims bear fruit as well. So claims definitely have also seen an equivalent increase over the last few years as well. Again,
Mm,
our report tends to highlight statistics around these as well. Again, emerging markets, just the fact that usage of these solutions have only seen an emergence in the last few years, the corresponding claims are coming. They tend to be focused around breaches of reps around financial statements, material contracts, tax. These three tend to be, probably covering about 70% plus of the claims that appear on such transactional solutions. And I think it will bear more fruit over the times, because if transactions are using more W&Is, then the claims will feature as well.
Are insurers pushing back with tighter underwriting as a result of this, or are they still competing aggressively on price and coverage?
Typically, you would expect insurers to push back, but again, something which I said at the start, that with new entrants into the market, with sort of a coming out of the woods of M&As in Europe, Americas, etc., the shift in underwriters' focus on emerging markets, continue to ensure that there is more than enough competitive space, competitive pricing that still continues. We would not sort of expect that changing over the next 12, 18 months for sure, unless there are large claims which come in. Again, I don't expect a lot of that to change in the next 18 to 24 months. Yeah.
Tax insurance seems to be the breakout star, so to speak, of 2024, especially in renewable energy projects and deals. Why is tax risk such a hot button issue in that sector now, and how is it being underwritten differently from traditional deal risks?
Tax insurance relates to a specific sort of area which deals with tax indemnities. In terms of renewable energy, it relates to demand for sort of investment tax credit, right? And or production of tax credits. Now, that's a specific, line item when you look at transactions in renewable energy space, or generally, even if it's a corporate M&A transaction. So tax tends to be a specific policy. There are times when, clients don't look to cover the whole suite of reps and warranties, which typically gets covered at W&I, but they want specific solution towards the identified tax issue out there. Now, that is where tax insurance has seen the upsurge. From a Marsh standpoint, I can tell you this has been one of our fastest growing product, if I have to say, under the transactional risk solutions umbrella. It's a specific line item, a specific issue that gets housed under the tax insurance.
And obviously, you look into the future, and with Trump's latest trade war moving beyond rhetoric and into the real world, potentially reshaping global supply chains, what implications could that have for cross-border M&A insurance, particularly in sectors with exposure to tariffs and export controls or national security review processes?
I think, Michael, it's slightly early to say or speak to this because, again, we all don't know what's going to happen in terms of how these things are going to take shape, in terms of how the geopolitical, world will respond to this. From where I sit, I think this is a time where it's going to give rise to more opportunities, especially for countries in the African continent. Because if you look at how the numbers stack up, the percentages on countries like China as compared to percentages being levied on countries in Africa, there is a difference, right? And the African countries are being levied a much lesser percentage of tariffs as compared to a lot of the other countries. So I think it's an opportunity where countries in Africa, which are sort of probably going to focus adequately on building scale, building sort of their manufacturing capabilities or building their investment capabilities. I think they have a very critical role to play in how the supply chain can be driven from specific investment opportunities.
Do you think we might see deal makers bundling political risk insurance with more traditional TR or W&I policies in response to this escalating geopolitical volatility?
If I got your question correctly, Michael, I don't believe that the underwriters would shy away if there's going to be a level of geopolitical uncertainty as a result of what's happening out there, where they will stop underwriting certain sectors or stop underwriting certain transactions coming
Right.
from a certain region. As I said, because there is a decent amount of competitiveness that exists on the W&I or on the transaction risk side of things as of now. So I don't think that'll happen. Again, it's a little early to say how everything will get impacted, how the global world shifts as a result of what's happening. But I don't believe that the underwriters will shy away from covering risks because it's never been a better time for transactional solutions as we see today.
Absolutely. And to bring this kind of highly specialized insurance to bear in the market presents, I would imagine, a fantastic opportunity. Looking ahead as we finish off to the remainder of this year and into next, the report does hint at potentially tighter underwriting if M&A volumes surge. Do you foresee pricing hardening next year, or will new entrants keep competitive to your earlier points?
Competitive, I think what will change is, and we've seen this historically, is that underwriters start to cherry pick when they're sort of expecting an upsurge to happen on the M&A activity across the globe, right? So, let's just consider 2021, which was a record-breaking year for M&A activity in sort of the more Western world. The underwriters used to cherry pick transactions that they wanted to do in emerging markets. But what that meant is, in a universe of, let's just say, 20 odd insurance companies that used to write emerging markets, you would have probably lesser players looking at a certain transaction in a certain jurisdiction, but not that they were not being competitive, right? So I don't think the competitiveness will go away. Yes, if there's an upsurge in transactions across the globe or in the next year or so, or probably over the next 18 months, insurers might cherry pick what they want to do, but competitiveness will remain, the coverage will remain as robust as it is. I don't see that changing immediately in the near future.
You've worked on over 200 deals in your career, Nirav. When you look ahead, what one area of innovation in TR insurance excites you the most?
Interesting. I think the way at least I've seen, let's just say the last 12 months, I hope that underwriters continue that momentum, especially when, historically, having looked at emerging markets pretty much all my life, I used to have underwriters say, okay, we won't touch this sector or we won't touch this jurisdiction just on the fact that it spoke of a certain geography or spoke of a certain sector, which is no longer the case and definitely not been the case in the last 12 months. So I hope that that trend continues because, we want to deliver the best for our clients and we don't believe that they should be prejudiced just because they are operating in a certain sector or in a certain geography. Emerging markets probably are as critical as I would say the more mature markets in the development of transactional solutions and the development of how coverages can be made more robust and competitive. So I would probably say that I would like to see this trend continues that underwriters should not be saying a no-go from day one. I think that's what I would probably say, I would want to
Mm,
see.
mm. And it ties into what the CEO of Standard Bank Group, Sim Shabalala, said recently, expressing concerns that international credit ratings agencies overstate some of the risk associated with African countries, and it leads to disproportionately high financing costs. And he highlighted at a recent B20 summit alongside the G20 Sherpas that these inflated risk perceptions result in African nations paying significantly more, sometimes up to 500 basis points higher, for debt compared to other countries with similar economic profiles. So it'll be interesting to see how this starts to come through in the way insurance is priced and also the level of deal activity that hopefully we start to see in the market. Now, I've got to ask you just one final question. I know it's a big buzzword and everyone's talking AI at the moment, but they're not talking Trump and tariffs, of course. But as AI and data analytics increasingly inform underwriting in other areas of insurance, are we likely to see these kinds of algorithmic tools being applied to transaction risk assessment? Or is deal risk still too idiosyncratic and judgment driven for that shift just yet?
I would probably say it will come, but I don't think it will replace a underwriter's perception and how they probably price the risk or how they develop the coverage around a particular transaction. I think what AI can potentially replace is to clear off what are the reps and warranties, tick, tick, tick. What are the corresponding due diligences against each of those reps and warranties, tick, tick, tick. But how, those sort of correlate to each other, how robust they are. I think it's too early where AI probably needs a few more years before that can be replaced and the human element is out of the room as a result.
And that's a wrap for this week's Monocle Banking Podcast. A big thank you to Nirav Modi from Marsh for unpacking the evolving role of transactional risk insurance in today's M&A world. There's one key takeaway. It's this: in an era defined by complexity, whether it's geopolitical tension or regulatory fragmentation or mispriced sovereign risk, I think as the US is showing us at the moment, transactional insurance is no longer just a tool for large cap buyouts. It's becoming an equalizer. It's becoming something of a confidence builder and perhaps a way to challenge the narrative that Africa is inherently riskier than some of the numbers suggest. As Sim Shabalala rightly pointed out, the cost of capital in Africa is often based on perception and not data. But maybe, just maybe, products like tax insurance, synthetic warranties and political risk overlays can help us start rewriting that story, not just in the boardroom, but in the balance sheet as well. If you enjoyed today's conversation, don't forget to subscribe, share and join us again next week as we explore more intersections on banking, strategy and innovation. For now, I'm Michael Avery, and until next time, keep your risk measured and your thinking exponential.